Good morning. This is a founder's post, and it's going to be our Sunday substitute this week for the founders CFTC discussion. But, or I should say, and hopefully it'll be informative. We're going to go through a couple things here. The first is I'm going to recap Friday's action. It was jaw-dropping. We're going to go through that in detail, at least from the biggest picture detail, and some perspective on my own observations career-wise. There's been nothing like it. That's the first thing. The second thing is there's a lot of interest in options. And as an options person, I am an options person. I have neglected it over the last year because, let's face it, there's just been so much news and so much activity and so much interesting information coming out about precious metals in general that I haven't had time to focus on the options. And I also focus on them when I'm teaching it in class, and I'm not teaching that this semester. But there's been a lot of interest in the information that I've shared about my own position. So, for example, I put on a ratio condor recently, and I want to go through that, take that opportunity, since it's not hypothetical, since it's real, to share it with you all. And what we're going to do is I'm going to condense 3 MBA classes into one session, and it won't be long. And that's because you're not MBA knuckleheads. You're all experienced traders, or put it this way, you're people who have been through the ringer a little bit more than college kids. But if you're a college kid, I apologize. We do have some people from UConn that remain signed up, and I love them for it. Very happy to have them here. Anyway, the 3 classes are beginning, intermediate, and advanced. So in the beginning, we're going to go through options from the view of the condor. I'm going to define it, describe it, explain the risks and why you do it and when you don't do it. And then the intermediate will go through how to use a condor and how to decide when to use a condor, what circumstances come up to make you say, hey, maybe I should do a condor. And then the third one is I'll show you my position in P&L graph form so you could see what a ratio condor looks like, which is basically a condor that says the market's not going to move, but if it moves, it should move higher. So I'll share all that with you. Hopefully we'll get this done in a timely fashion. So the recap, the beginning, the intermediate, and the advanced Russia, listen to me, condor thing. I have Russia on the mind considering their gold holdings are at all-time highs. So let's start with the recap. Now, regarding the recap, the first thing I'd like to draw your attention to is the last thing that I noticed, and that is the open interest is cratering. Now, this first chart, these are all courtesy of Randy, a mainstay at the founders meeting, who has taken concepts that I've discussed and made them into very handy tools for us all to use. And I thank him for that all the time. And I thank everyone for the contributions. This is a short-term chart. Now, the red line, all we care about here is the red line as it pertains to the gold line. The blue line is a moving average. The red line shows you open interest on the COMEX in gold. And as it's labeled, it's number 2, short-term open interest. And you could see that the open interest cycles from low to high, from low to high, from low to high, but it's actually gone lower than its normal band. Usually it stays in between those green lines that Randy drew. And you can see the market is making higher highs and higher lows. But now the open interest is making lower lows. So that warrants a little bit of a zoom out. So we go out to the next level, and you could see going back to chart number 1, which goes back to 25. This is basically a year snapshot. You can see the open interest is below the lowest it's been for the last year. Now, while I'm pulling up the last chart, this is the one that I care about. Essentially, going back to 2022, which is when Randy started doing this, way back in the early founders classes, we're at all-time lows in open interest. Now, there are massive implications for this, many varied, and almost all of them are bullish for the market. Let's start with the one that's has nothing to do with the market itself. The marketplace is dying. I've made this contention before. I've contended this before, that COMEX is losing its validity as an exchange, and people are packing up their things and going home for the summer, or maybe for the rest of their careers. And this is the evidence of that. We identified this about a year and a half ago when I put out that piece, COMEX is dying. And that was because there seems to be a reticence to put on risk on the COMEX now, simply because if you do that, you might be handcuffed. But without getting too esoteric about it, the action is in Shanghai now. The volume is in Shanghai. The speculative buying is in Shanghai. And that means the COMEX players, the bullion banks, if they want to sell it, they should not be selling it in Shanghai and here. They should be selling it in Shanghai. And so what they've been doing is they've been covering open interest here all the time, because the whole neighborhood moved to, metaphorically, the new shopping mall. The new shopping mall is Shanghai. And so the COMEX is closing down. So when you see the COMEX open interest drop like this, that's because shorts are covering when it rallies and shorts are covering when it drops. Now, the shorts are covering when it rallies. That's obvious because it's rallying and open interest is coming in. What's less obvious is the longs are getting out in the sell-off, and those longs are getting out and the shorts are covering. So the whole exchange is going the way of the dodo bird, at least for now. Maybe it's cyclical, maybe it's secular. But you could see that without getting into the graph too much, you could see that the open interest cycles. And the open interest cycles at higher highs and higher lows and lower highs and lower lows. But the market, since 22, has cycled at higher highs in the market, even when the open interest has cycled at lower lows. And we covered this very extensively. And we were very interested in this area right here, where the open interest is making higher lows. This is when the macro discretionary was getting in. This is the macro discretionary getting out. But as they were getting out, the banks were covering short. So the market never went down. This market is being managed, my friends. All right. So that's the backdrop. The backdrop is the market continues to go higher even at open interest craters. Now, the reason I bring it up so pointedly, going back to this one here, is this is how a fish hook goes. A fish hook is basically a market that makes new lows. It could be on the top as well. I guess it would be an inverted fish hook. A market that makes new lows, and the open interest comes in and comes in and comes in and comes in because it's the longs puking, which is what you're seeing now, Friday notwithstanding. And the market then goes lower and usually leaves a long wick underneath. And that long wick closes out. It could close out negative. It could close out unchanged. It could close out positive. But it leaves a long wick. And on a day like that, you see the open interest either go down a tiny, tiny bit, or it goes up a little bit. Now, you can't see it. Let me zoom in. Let me zoom in a little bit on this. How about that? You can't see it, but see that there? That's the open interest coming off the very lows, with the market leaving a long wick and going up. This market dove and then came up. This is a fish hook. Now, I'm going to be honest with you. I've never seen a fish hook this big. I've never seen a fish hook this steep. I've never seen a fish hook from these lows. If you believe open interest is damaged and the COMEX is damaged, you are less likely to be bullish about this. If, however, you believe that that is true, but more importantly, in the shorter term, this is a short-term bottom, then you're looking at a massive fish hook. Now, fish hook is my euphemism because they ended up looking like fish hooks all the time, but you could see them in other ways too. Bollinger Bands will represent it. You'll see it with a long wick at the bottom. You could also see it as a morning star, where the market makes a new low, leaves a long wick below, and then next day the morning star wouldn't form until after this day. But the point is, if we're going to go up, now is the time to go up. Right now. So I'm not telling you to be bullish. I'm telling you, if we're going to go up, now is the time to go up. Now, I believe it'll be more bullish for gold than silver, but it's not going to be bearish for silver. I can't throw water on this, even if I want to. Let me pause for a second here and recalibrate my pictures. Which brings us to the actual chart. It's a cursory technical comment I'm going to make here. This is not a bullish structure. This is a bear flag forming. Okay, I'll draw a little line here to make it more obvious. This is a bear flag. Now, mind you, it's only a bear flag if we break through this bottom here. It's forming a bear flag. A bear flag is down, contrary move, very much respects Fibonacci's. Down to here is your low, and this is, let's say, that's your 1/3 retracement. But if it gets above a certain level in here, all bets are off. And this becomes a massive new structure like this. And this whole thing ends up looking like this. And that's the name of that tune. It's crazy. But this whole area here, all of it, is bullion banks covering in the rally and bullion banks getting bailed out and buying on the dip. I do like the fact that we have an 8 here without a 9. That means it was almost ridiculously overbought, gave all of its overboughtness back, and now we're looking for something like this on the downside. By the way, if you're wondering about these are DeMark indicators, 8s and 9s. It goes from 1 to 13, but I label the 8s and 9s. And by the way, in a bull market, you always get overboughts. You never get oversolds. Because the overboughts pause up, pause up, pause up, pause up. If I sound a little euphoric, it's because, well, it's early in the morning. I've had my coffee and I'm just not going to pull punches. This is just crazy. So if you're a technician, you're a buyer above some line that goes like this. Maybe you're a buyer above that. Me, I'm a buyer above the close. When I say I'm a buyer, that doesn't mean literally. It means I'm a person who's considering buying. That's how traders talk. All right. I mean, Jesus. There's a new ledge. Look at the size of these ranges. Look at this market up $190. That's wicked. Now, why would it move so much after such a steep decline? I'll tell you why. Because the banks aren't interested in price anymore. They're interested in getting their contracts. So they bought here, 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 and here. And then they bought here, 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 and here. So their average price of covering is still below their average. Their purchase prices are still below their average. So if they were buying in here, and I'm telling you they were, and they were buying dips as they were coming in here, let's say they all bought it here. Let's say they bought perfectly here, here, and here. Well, they're still buying below their average. Okay, this is how it works. When you've been mandated to buy 20,000 contracts back, you don't care about the price, you care about the contracts. And so that is why we had to rip off the lows, in my opinion. I have no proof of that. Complete speculation. But I'm probably right, as a person who's been on both sides of this. Now, let's move to silver for a second. Excuse my sniffles. Silver is not a bull flag. I mean, a bear flag. Silver is still in a bearish mode. But you see these two levels here? I drew those yesterday before the market closed. This is where I decided to get bullish or neutral. This is where I put part of it on, and I put the other. I told you I put 1/3 of it on. I put another third of it on yesterday, and I'll show you what that position looks like. But this area here, now why did I pick this? Again, I'm rationalizing my own position here. Let's be clear about that. This isn't scientific. I do science, but science isn't as fun to talk about. Science backs up what I'm saying. Science, in quotes, right? This is where JP Morgan flipped from short to long in silver. This is where beyond Jiming, the Hunt brother, the anti-Hunt brother now, sold it. And this is where JP Morgan, I think, said, screw it, it's not going below here. Now, are they buying it because they're bullish? Yeah. Are they buying it because they have an order for the government? Possibly. Are they buying because they have an order for the Chinese government? Also possibly. But I'm not married to any of those ideas. The only thing I'm married to is this. They bought it here. They bought it again here. They bought it 5 times here. It broke it and went back above it. That, to me, is my beautiful, beautiful type of trade. Here's your ledge. Here's your triple bottom, quadruple bottom, quintuple bottom. Broken, rejected. In the words of an old technician, the downside is closed off. If we get above here, look out. So basically, he would say the downside is closed off for now. I wouldn't be bearish until we got all the way down below here now. Even if it gets down to here, I wouldn't be bearish. He goes, however, I would be bullish if it got above here. And that's what he would say. And that's what I did. So that's the market. That's not a recap of the day itself. So let's do a little bit of that. Let's walk it through the hourly. What can I say? What can I say? Bearish. And by the way, there were several news items that coincided with the move lower. One was the margin increases. Another was the Chinese Hunt brother getting bearish, and another was the fund in China being shut down. All those things were primarily silver focused. You could also make the case that the India-US trade deal was a bearish driver, but I'll tell you, we rejected a lot of it. This market is it's a monster, folks. These vicious turnarounds that we started witnessing over a week's period of time in 22 and 23 have now happened on a day's time. These are vicious. I have never seen anything like this in any market in my life, in my career. I started in 94. I'm going to give you a little list of some of the scandals and trading things that I witnessed or was a part of. MG, the oil scandal. I was a clerk. Copper Sumitomo scandal. I had a position on there and I had a trader in there. 1994, Warren Buffett cornered George Soros cornered silver. 1997, Warren Buffett cornered silver. 1993, 94, BCCI scandal. 1999, Gold Ashanti, the Y2K scandal. 2011, the Blythe Masters crushing of the silver shorts. 2009, various things happening with the crisis. 2016, the Brexit spike. I have never seen a market act this way before. That's not to say it hasn't, but look at these ranges. You've never seen anything like this. I might sound like I'm not biased. Most of the money that I made in my career has been in natural gas and oil, and gold and silver have been the first money I made. But I could say this is the greatest market of my career, in my opinion. And there's nothing that comes close. In a metal that's supposed to be boring, it's not energy, it doesn't get consumed. There's a massive global war going on. Anyway, what can I say about the actual trade itself? Look, an 8 and 9 on the hourly, boom. An 8 and 9 on the hourly that was rejected, right? We're in a sell-off. Rejected. So now you have an 8 and 9 up here. We should go sideways or lower. If we don't go lower and we get back above the 8 and 9, you're a buyer. You're a buyer above 50.92. That's what you are. Because above 50.92, you get above that wick as well. Silver, more interesting, less bullish. This is where I have my position on. Now, here comes the plug. I'm not getting paid for this, but I'm going to tell you that's very good. This is This is an options tool that TradingView has. Now, a quick comment about TradingView. Let me get their name up there. TradingView, I've been using since 2016, and it's never been it has not in the past been my go-to product, but I've seen this thing. It's gotten really good over the years, and they're adding layer upon layer upon layer. And well, frankly, I was a subscriber to the pro level years ago as it got better, and the pro level is not cheap. Let me be clear about that. But they saw fit to comp it for me, so now I have it for free. And let's call that a sponsorship, if you will, of Goldfix. And I think it's a good product. And I'm going to tell you straight up, the free product has a lot of ads, but it's good if you're a tourist who comes once in a while. If you're going to be on it for a little bit more than 5 minutes a day, then you might want to end up getting the premium. The pro is just, you don't want the pro. I want the pro. You don't want the pro. I would say this to you. They're probably going to fire me for saying this. I would say this to you. If you have an account at Thinkorswim, you're going to have all these tools for free, plus real-time feeds for the Comex. So you can't get real-time feeds for the Comex on this anymore, even though everything else is real-time. That's because the Comex is really strangling their CME feeds. But anyway, this is a long call. Let's talk about the graph here. This is a long call. We're not going to use this for the tutoring today, for the teaching today, but this is a long call at expiration. This is a long call before expiration, and this is your volatility position. So this is a very, very good tool. I can build condos on it. I can build everything, but it's going to be a little bit too busy for us to use right now. Let's move to the options section. We'll start with this. That's a condor. And what you have on the screen in front of you, let me see if I can make it a little bigger. Is a silver March futures call condor P&L at expiry, normalized. The most you can make is 4. The most you can lose is 6. Very simply. Now, as a background, you may remember me talking about when volatility is extremely high, you don't want to buy or sell naked options.